The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
No mercy, no malice. Investors get ready for a make or break week. Live from Studio 2, from Bloomberg headquarters here in New York. Hi, I'm Romaine Bostic.
And I am Katie Greifeld. We're kicking off to the closing bell here in the U.S. A down day to start this week. The S&P 500 off by about 0.7%. A lot of that weakness coming through in your tech names. The NASDAQ 100 off by about 1.8%. The big action is underway in crude oil right now, higher by about 9%. We're trading above $80 a barrel. Of course, we heard from the president earlier today, reinstating that U.S. blockade on Iranian ships through the Strait of Hormuz, talking about a 20% reimbursement for all other cargo, as you would imagine. That is sending energy prices higher. Also seeing yields come higher as well, to the tune of about 5 basis points on your 10-year Treasury yield. A lot of talk about what this Fed is going to do and whether that will involve rate hikes, Romaine.
Yeah, those last two numbers on your screen there really a reminder that that summer doldrum feel that we had last week, that's going to really confront a packed calendar of catalysts this week. That includes some key U.S. inflation readings, data on retail sales, Kevin Warsh's first congressional testimony as Fed chair. You have AI cycle updates from ASML and TSMC, and you have the official start of earnings season, where expectations, they're sky high, not just for big tech, but also for some of those big bank earnings.
Can the mega cap banks really exceed the mega expectations that have been put on? So the whisper numbers from the buy side or the investor base, especially for Goldman and Morgan, tend to be higher than where consensus is. And so with 5 of the 6 of them reporting and expectations ratcheted up pretty high, I'm a little bit nervous that tomorrow is going to be a little bit of a mess.
Yeah, and a mess indeed, particularly where you have these crowded trades that are certainly going to get audited. It's a scenario already playing out for chips, where the Philadelphia Semiconductor Index down 15% from its record high on June 22nd, and the South Korean Kospi Index, the best performing major equity benchmark, caught in a torrential sell-off that's pushed it down 25% in 3 weeks, as investors really starting to deleverage and reparse just where they want to sit in that AI trade. Now, adding to the anxiety is that creep higher in yields that Katie was showing. The 2-year Treasury now at its highest since February of 2025. Renewed Iran tensions out there, pushing up oil prices, and fresh comments from Fed Governor Chris Waller that one more hot reading on core inflation, that would mean the FOMC should actually consider tightening monetary policy.
And we'll get an update on that measure tomorrow morning at 8:30 a.m. So certainly, as Romaine said, a make or break kind of week. But let's talk a little bit more about the bond market and how the dynamic with inflation expectations is shaping up. Because behind me on this chart, in blue is your 2-year Treasury yield. In white is your 10-year break-even rate, which is basically a proxy here for looking at inflation expectations. As you can see, these two lines, despite being different tenors, they've really tracked each other through much of this year. But then you saw a big divergence basically erupt when it comes to May. You saw, of course, 2-year yields continue their climb higher, now at the highs in over a year here. But you saw 10-year break-even rates really take a dive lower. The question was, how did these two lines come back together? And if you really train your eyes towards the right of your screen here, you can see that 10-year break-even rate, that inflation expectation proxy, beginning to bump back up again, Romaine.
And we're going to get some insights on where yields are going and, quite frankly, the rest of the market. But we want to kick things off today with a look at a major deal shaking up the world of investing. 90-year-old asset manager Russel Investments agreeing to be bought by a group led by venture capital firm B Capital, as well as CalPERS, one of the biggest pension funds out there, a move aimed at priming the company for the AI era. Pleased to say joining us here in Studio 2 is Kate El-Hillow, the president and CIO over at Russel Investments Group. Kate, great to have you here.
Great to be here.
I do want to start off with the news that Bloomberg broke last week and that now has been confirmed. A historic firm in Russel Investments, going back 90 years, pairing up with a relatively young venture capital firm. What's the relationship there?
Yeah, well, I'd say first it's a great outcome for your clients, and the associates and investors. But we're at a pretty unique inflection point, I'd say, in lots of different industries and sectors, and having the benefit of capital partners coming in that have a really strong technology background and a track record of really leaning into companies that are looking to shape the industry, I think is a perfect timing for B Capital to come in, paired with CalPERS, who, think about it, long-term investor, retirement focus, financial wellness, really aligned to Russel and how we think about managing money. So a good complementary combination.
Yeah, the biggest pension fund out there. And I am curious, is this kind of starting to become a little bit more of the model out there? Not so much the B Capital side, but the idea of having a big pension fund like this kind of own a piece of the plumbing, so to speak, of what's really going on out there.
Yeah, I mean, having that alignment in terms of long-term capital, which is very much how most clients think about their investment strategy and decisions, is a positive. And we've seen it with some other asset managers out there, where you're seeing asset owners with that kind of long-term focus, leaning into owning companies like ours.
And talk to us a little bit about, how you're going to be approaching AI under this new ownership structure, because it's something that we hear about a lot when it comes to asset management, and you sort of hear these statements and they're hard to grasp. How do you see that actually impacting the way that you look at investments and you manage money? Yeah,
well, I'd say, first, the great thing is that from a client perspective, from a platform and a team perspective, it's staying the same. And part of this is a platform play. Russel allocates to all the best investors in the world when we build portfolios, and it gives us a unique set of data and insights that we have to work with when we're managing clients' money. Having more robust and maybe a bit of a bolder approach in terms of investing in technology to help think through how we can take advantage of that kind of data set as we're thinking about managing money for client portfolios is probably one of the key excitements that we have around this. And it can be around thinking about managers that we're investing in. It can be around just being more scaled at how we're customizing solutions for clients. It could be on the retail side in tax, or managing a pension plan's liabilities more effectively. But technology and data and AI helping us be more dynamic is the backbone of a lot of those decisions.
And you touched on this a little bit, but Russel, of course, is known for being one of the largest OCIOs out there, outsourced chief investment officers. And it's an interesting way of approaching investing, taking a look at all these different funds and managers and sort of putting them together. And I wonder, in your view, why you think that style of investing, why OCIOs in particular seem to be gaining more traction in this kind of market.
Yeah, I think part of it is you have the flexibility to make adjustments to the strategy as you need to. So it's the balance of being long-term focused in terms of your objective, but not being so anchored to one investment strategy in terms of how you actually manage the portfolio. So if there are shifts between public and private, or different types of strategies that are in or out of style, we can make shifts very naturally because we're independent and objective in terms of how we think about allocating capital. And so I think in an environment where structural change is something we all need to be understanding and thinking about longer term, having flexibility about how you're getting diversification in your portfolio and using different types of strategies to do it. Open architecture gives you so much flexibility to find some of those ways.
Well, let's talk a little bit more about the markets in the here and now. Obviously, you got more than $400 billion under your purview here, coming off of a first half that was relatively decent, no matter the asset class, with save for a couple of here. As you look at what's happening with regards to the earnings picture and the trajectory, the macroeconomic backdrop, and still a lot of uncertainty on geopolitics, is there a rethink in what your outlook and your investment strategy should be going forward?
Yeah, well, I'd say the reacceleration we entered the year in, is not kind of our base case anymore, but the resilience that we're seeing, in the economy, whether it's geopolitical, rates volatility, or just general kind of shifts in terms of sector leadership, diversification, and being really disciplined about how you're thinking about the market environment, we think is critical. In some ways, it feels like a bit more of a trading environment that we're operating in, and so being able to be disciplined and thoughtful about when to trim those winners and how you want to think about what is that next strategy to allocate.
I understand the argument for diversification. I mean, obviously, that's an age-old argument, but then people look at, the AI stocks, the chip stocks, and they don't want to miss out on that. Then you start to get this broadening out of the trade.
Right.
And then something happens, Iran or something else happens, and everybody sort of goes back into that funnel of those, 5 to 10 names that have taken us here. Is that just kind of the cycle that we should prepare ourselves for that?
Well, I think you need to make sure at the total portfolio level you're positioned for where the world is going, and you need to understand there's different ways to get exposure to that AI trade. And so you're looking at different exposures in your portfolio and making sure you're positioned for where that structural growth is critical. But once you've done that, making sure that you're not too anchored kind of that particular trade, and like how you're actually getting diversification in the portfolio where inflation could start to spike up again, or there could be different risks that are, the portfolio is very exposed to. Those are equally important. So when we say diversification, it's making sure through different types of market environments that you have built the portfolio to be able to withstand drawdowns. And so it might not be fixed income that is your best diversification approach that you're thinking of. There might be certain types of hedge funds that you want to allocate to. And so being thoughtful about that, that's when we say diversification. It's about the types of strategies and asset classes that you're investing in, as well as the underlying stocks and bonds.
Well, what are your expectations for inflation? Because, again, we heard from Fed Governor Christopher Waller earlier today saying that if we get another hot reading on core inflation this week, the FOMC will really need to consider tightening monetary policy in the near term. So really putting that rate hike question back firmly into the conversation. And, I wonder if you view the stakes as being that high as we head into some of these inflation readings.
Yeah, well, our view was, the protracted kind of, basically just status quo, coming from the Fed, absent the escalation, in the Middle East, starting to take, hold again. And so inflation's a concern, but back to earnings and what's really driving this market, that's where we think the focus is. Yes, rates kind of starting to back up is important, and a material shift in inflation expectations could be a concern, but not shifting at this stage on that front. It really is around earnings and what we're going into, and whether AI capex is going to continue, whether input costs are starting to increase, or even are we starting to see some profitability and ROI signals coming through, and where the investment's happening. In our view, that's much more important than just this next inflation reading or kind of a hike that could happen at the back half of the year.
There has been some concerns, even as people try to measure that ROI, whether it's on the productivity side or whether it's the actual tangible whatever coming out of data centers or whatever, but the costs going into it, which as we know is exponential, certainly when it comes to the data center build out here. Does that worry you at all that maybe there is a bit of a mismatch between the upfront costs and the potential return down the road?
There's going to be winners and losers, and there's no doubt. And so where you lean in is going to be an active decision, and some of it's going to be how people decide to invest, which models they're using, how they're measuring that ROI. We see it at our own firm, and I'm hearing this from a lot of managers. People are using the most expensive LLM, the most expensive models to do things that you can use a cheap model for. And so being more disciplined about how people are rolling out AI and being realistic about how long it takes to really get that embedded in institutions and different sectors is important to kind of keep balance with.
All right, Kate, really wonderful to have you. Kate El-Hillow, President and CIO over at Russel Investment Group, kicking us off to the close here on this Monday afternoon. When we come back, a conversation with the CEO of Chipotle, Scott Boatwright, about to go where Chipotle has never gone before. That conversation coming up after the break right here on Bloomberg. Some breaking news. We've learned that Chipotle, the Tex-Mex chain that is primarily based here in the United States, is set to open its first location in Mexico later this week. It's a substantial expansion that will eventually extend to Mexico City in 2027, and it's part of a broader international expansion by relatively new CEO Scott Boatwright. We had a chance to sit down with Scott just a few minutes ago. Here's what he had to say about the opening.
We believe Mexico is a really important milestone for our great brand as we continue to lean into our global strategy. It's an important country for us. We recognize and admire the culinary heritage that is a part of the Mexican culture, and we respect what we believe to be some of the best food in the world. What we're working to do is really tackle this emerging trend that we see around the globe. We also see it down in Mexico. This idea around fresh ingredients being prepared same day freshly in restaurants. And we believe what we do and what we offer will really resonate with the Mexican community.
I know you've had to have done a lot of market research, and there's been a lot of talk about this idea of just how prolific not just Mexican taquerias are, but obviously all of the sort of unauthorized stands. Anyone who's walked around Mexico City, Monterrey, these big cities, they are everywhere. And I saw one stat that said that basically if you live in an urban area in Mexico, you don't have to go more than 200 or 300 feet before you find a taco cart of some kind or another. Have you factored that into your equation, that you're not just competing against established chains, but basically that ma or pa, so to speak, on the street selling food from their carts?
Yeah, it's a great question, and we have. And so we have partnered with what we believe to be a world-class partner in Alsea in Mexico, who has brought other U.S. brands into the country at a very successful pace of growth. with brands like Starbucks and Cheesecake Factory, and they've done an incredible job. So we believe the right partnership, strength of the partnership, and the opportunity to go into Monterrey first and showcase the brand in a really unique way down in San Pedro is really step one. As we continue to move through Monterrey and open up and expand, we'll have our sights set on Mexico City next. But we believe what we offer, the idea of the best ingredients in the world, prepared fresh in restaurant daily at an abundance and variety and speed, which is unmatched, at a really competitive price point, will resonate well with the consumers in the market.
Well, Scott, as you mentioned, you're starting in Monterrey. You have plans to expand into Mexico City a little bit later in terms of timeline here. Talk to us about that cadence, why you chose to start in Monterrey, what sort of boxes that region checked for you.
Yeah, if you haven't been to Monterrey, it's a really beautiful city, really progressive city in Mexico. We love the trade area. We love the consumer profile in that market specifically. We plan to expand at a very measured pace to show that the brand can work in really any geography around the world. We think Monterrey is a great starting point for us. We'll launch the brand there, move to a number of restaurants, and then move to Mexico City, where we think we can be hyper successful in a really large metro city that is probably one of the largest cities in the world.
Well, as Romain sort of hinted at, there's a little bit of irony when it comes to the fact that Chipotle Mexican Grill is opening up, expanding into Mexico. And with that in mind, what changes do you have planned for Mexico when you think about pricing, your menus, potentially your ingredients? What are you adapting to Mexico? What are you keeping the same?
Yeah, so we plan to use the same menu we have here in the United States in Mexico. We'll locally source as much of the product we bring over the border today as it relates to avocados and tomatoes and peppers. We'll locally source those, but it'll be the same menu we've launched in Western Europe, the same menu we launched in the Middle East with our partner Al-Shaya. We have 15 restaurants open in that region today, and the brand really resonates well when we deliver on standard the same execution and same menu that we have in the United States.
With regard to your partnership with Al-Shaya, I mean, this is a licensed model. And I am curious that given that you pretty much own your stores here in the United States, how do you sort of ensure that, quality control, both on the ingredient side, but also in terms of service, is going to be up to the same standard that anyone would expect in any other location?
Yeah, I think it's really about when you go into a new market is really assessing the partner quality. We believe in this idea of a slow, measured approach to global expansion. We're not opening restaurants at a fast pace just for the sake of opening restaurants. We're going to protect the quality of our great brand through the strength of the partnership, management of the supply chain, and then oversight on how we deliver the experience each day to each community in which we serve, whether that's in the Middle East, Latin America, and/or Southeast Asia, which will open up later this year.
Well, I'm curious, how far do you want to take this international expansion? Obviously, you're a relatively mature company, 30-plus years old, primarily here in the U.S. You have the partnership in the Middle East. You referenced the partnership in, I believe, in South Korea, and now in Mexico, Latin America. Is this the longer-term growth story for Chipotle under Scott Boatwright?
It is. As we continue to expand in North America, we have a really strong business model here. We have an incredible team that is opening up restaurants at a record pace. We'll open up in North America alone this year, north of 350 restaurants. So we feel like we have a really good foothold here, and we understand how we deliver the model and how we deliver on consumer expectations and preferences in a really meaningful and unique way. What we endeavor to do now is, as we build Chipotle to a global iconic brand, is really showcase that the brand works in every region of the world. At the heart of the menu, it's really rice, beans, heavy protein, and heavy veg, prepared fresh, which we know is not unique around the globe. And we're going to showcase in a very slow and measured way that we can be successful in every region of the world.
Well, Scott, you mentioned heavy veg, and I want to apologize for this next question since we are talking about food, but we have to talk a little bit about cyclosporiasis. I hope I'm saying that right. It's that parasite that's been linked to severe diarrhea. We've seen outbreaks in more than 30 U.S. states, and they're usually linked to basil, cilantro, lettuce, things that I'm sure you use a lot at Chipotle. So what have you seen? What do you know about this? Have you seen any notices from your suppliers or anything along those lines?
Well, first and foremost, the care and safety of our team members and our guests is always our highest priority. We have gone through our supply chain ingredients with our partners to understand if any of our ingredients have been indicated in the Cyclospora outbreak, and they haven't to date. We don't expect that they will, but we'll continue to monitor our supply chain and be hyper vigilant to ensure we are protecting both our team members and our guests in our fullest way.
And our thanks again to Chipotle CEO Scott Boatwright talking about the chain's expansion into Mexico. And coming up on The Close, the CEO of Michael, he joins us in studio to talk crafting the company's ongoing overhaul and how consumer spending trends are molding the opportunity set. This is The Close on Bloomberg.
Time now for our top calls to look at some of the big movers on the back of analyst recommendations. We're going to start off today with American Express, an upgrade over at J.P. Morgan on the credit card company to overweight, calling American Express's revenues defensive in nature. The analyst also highlighting the power of the company's affluent customer base. The price target goes to 400, up from 328. American Express reports earnings next week. The shares up for a third straight day in a row. Next up, let's take a look at Deckers. Jefferies stepping in, up its rating on the shoe company to buy. This after having a hold rating for months. It's citing the strength of Deckers' Hoka sneaker brand. The firm now expecting the stock to run up to 130 a share, encouraged by recent meetings that it's had with management. Deckers reports earnings next week as well, and those shares up for a third straight day into that print. And finally, Humana. Wells Fargo boosting its rating on the health insurance stock to overweight. The price target goes up to 502. The analyst citing moderating cost trends for Medicare Advantage as a major risk reducer. On the earnings front, those shares up about 4% here on the day. And those are some of our top calls. Of course, Katie, three bright spots here on an otherwise down day, with the NASDAQ now down about 2% on the day.
Absolutely. Seeing that weakness come through in big tech. Of course, that's bleeding into the S&P 500, which just completed 2 consecutive weeks of gains, but it looks like a rocky start to a very, very busy week. Coming up next on The Close, I'm pleased to say that we'll be joined by Michael's CEO David Boone, joining us in studio to talk about the company's growth opportunities and what lies ahead for shoppers. That conversation up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these public equity markets, also keeping an eye on the retail landscape, and specifically Michael's. I mean, I'm sure you caught that Bloomberg story about how Apollo, of course, which owns Michael's, has sort of helped steer the chain to a really unlikely success relative to maybe where they were 1-2 years ago.
Yeah, and it's a great story. It kind of gets to this idea of obviously, good management, but also good timing, and the idea that a lot was going on in that retail landscape that helped to aid Michael's as well. It also was kind of interesting, too, to see just how involved Apollo was, particularly when it looked like things might have gone south when it came to the impact of tariffs.
Yeah, certainly. You think about April, May of 2025, a really tenuous time across industries, but particularly for Michael's. So let's, of course, continue this conversation with none other than the CEO of Michael's. His name is David Boone. He's sitting next to us. David, great to see you in studio.
Great. Thanks for having me.
So you told our Bloomberg News colleagues that Michael's had this reputation for basically being your grandmother's store. And one of the things that you had to sort of engineer when you took over as CEO in February 2025 was changing that reputation, transforming the brand. So talk us through how you even start going about something like that.
So it's interesting you say the grandmother's store. What I would say is Michael's is a beloved brand. There isn't a place that I don't go, our team members don't go, and you say, I work for Michael's, and people don't say, I love it. What I think was happening is we weren't really living up to our promise from an in-store experience point of view, from a category point of view. So we embarked on really a 3-point plan. You mentioned changes in the retail sector. Our industry had some exits, and so we consolidated the space. We moved into some new categories. And now we've begun transforming that retail experience, culminating in a whole new store concept that we just launched a few weeks ago in Columbus, Ohio.
let's talk about some of those exits, because Romain mentioned that timing certainly plays a role here. And you think about, how you have expanded aggressively in balloons when you saw bankrupt City or Party City go bankrupt. You also acquired IP and brands from Joann as well. They've filed for Chapter 11 a few different times. So, I mean, when you reflect on that, how much market share do you think that you've been able to take from some of your competitors and their untimely demise?
So I think about it in a couple ways. With respect to Joann's, that was a beloved brand with a very loyal customer following. So we worked really hard at pace to build out these knit and sew shops in 1,400 stores in 6 months, really unheard of pace in retail. And I think we're doing quite well taking share in those categories, pretty significant share. If you think about the Party City, that was more of an adjacent business to us. So balloons, party supplies, reasonably well-served market in party supplies. But again, we built the Party Shop by Michaels in that 6-month period. And I can tell you right now, at least in balloons, we have the most robust, compelling offering in the country, in North America, I would say. And we're growing quite a bit. So we're very excited by that.
I am curious about how you structured the stores, and you talk about the new concept, and maybe you can walk us through that, because this isn't just so much, okay, just find some shelf space and put this stuff on there. Particularly, I have people in my family that were really into Joann, and they were like absolutely devastated when it went under for the second time. But it gets to this idea of how you sort of capture the ethos of what Joann was inside the Michaels umbrella.
Yeah, so a couple things. So we, as you know, we acquired the IP, and there were some brands in there, one called Big Twists in the yarn category that we immediately launched within 6 months, brought that product out, that was beloved. We then expanded fabric into every store in the chain. In fact, we're now in the process of going back to existing stores and expanding the assortment. We likely won't have the same level of assortment in store that a Joann had, but what we've done is we now have hundreds of thousands of fabric assortment online, and I would hazard a guess to say the biggest assortment of cut-to-order fabric online in the industry. And so that's how we're serving that customer, and we branded these departments with Joann. So really trying to serve them for how the products they bought at Joann's when they were there.
Did most of that product come from the original Joann vendors, or did you have to reach out to new vendors in order to get that?
A bit of both. Yeah. So one of the things that we did do is we called all of the vendors that were former Joann vendors, and many of them were shared, into a big conference and said, look, we are going to step into this space. These customers are not being served. Help us get product as fast as you possibly can from in North America, from around the world, so we can put it on shelf, and that's what we did.
And you were able to do that at a favorable cost?
Yes. Yeah.
And so clearly you've found an audience here, and of course you have a loyal following, but I do wonder, I mean, thinking about the future and sort of expanding your addressable market for a lot of shoppers, for a lot of consumers, going to Amazon and hitting buy, I mean, that is the muscle memory. So how do you sort of insulate Michaels from that? How do you Amazon-proof your business going forward?
So one of the great things about arts and crafts and celebration is a very tactile category. The majority of our sales come through stores, and what I can tell you is we are attracting new customers and new traffic to our stores. We're attracting them online as well, but we're also attracting them to stores. So how do you go about it? One is having a distinctive assortment. The majority of what we sell is our own brand or our own brands. In addition, we have some good national brand partners. You create an inspirational and an experiential experience, things like birthday parties, events happening in store. And then you work with your team. We have many team members that are really deep into a particular craft or category that work well with our customers when they come into the store. So it really favors our environment.
And as we mentioned at the top, you know, Michaels is owned by Apollo. They bought you 5 years ago. So 5 years is typically when PE starts maybe looking for an exit. And I wonder, in your situation, you know, what that might look like. What sort of timeline might you be exploring here?
I'd say there's no specific timeline. It's obviously, as you mentioned, been some time since Apollo owned the company, so I'd imagine they'd want to make a return on their investment. But the management team is squarely focused on building the business, serving customers, and wowing them, quite frankly.
I mean, I know you're a private company, so we haven't seen public reports from you, but are comp sales, are they going up? Can you give us a sense here as to what the trend is?
Sales are growing, earnings are growing, and we're attracting millions of new customers.
You are still sitting on something like 5 times leverage based on Bloomberg reporting. Is there a plan to try to reduce the debt load and the debt servicing that you have under you before you make whatever next step you might make?
Yeah, you may be aware that we refinanced our debt earlier this year, so it was a big commitment by our financial partners and a belief in the company. And as our earnings continue to grow, we're able to pay down debt and we're able to reduce our leverage ratio.
Are you worried at all about any sort of reentrance into this space that could be a competitor of some type or another?
I don't, and for a couple reasons. One, the fabric craft business is very unique. It's very SKU intensive, hard to serve, and we have some unique capabilities there. We produce 24,000 new SKUs a year. We have that capability, so that's difficult to get into. With respect to party and balloons, we're ahead of our competitors. We expect to stay ahead of our competitors. And we haven't talked about one of the big trends that I think favors Michaels is the analog, we're calling it the analog revolution or analog hobbies. There is a back to the future, however you want to describe it, where people want to get off screens and do tactile things with their hands. They want to celebrate together. Things like analog hobby searches on our website, girls' night crafts, like these searches are going up through the roof, and so that favors a business like Michaels.
Yeah, it is pretty wild. It's something I've noticed in my own personal life, sort of the upswell of these knitting type groups. I do want to go back to the fact that you are PE owned, because I think it's really interesting that you have managed to execute this turnaround, you know, still gaining traction here. And I wonder, I mean, when you reflect on that, what have you been able to do in helping to pull that off as a privately held PE-backed company versus being a public company, as you know some of your peers had been?
I've been asked that question a lot, and I think the answer is we've been able to work and operate decisively and at speed. So when we made the decision, hey, we are going to go after these customers, we're going to serve them, we're going to go into these markets, we're going to go buy hundreds of millions of dollars of inventory to support them. We're going to update our stores. You know, we had a great partner in Apollo who allowed us to make those decisions quickly and take that risk.
I do want to ask you about the reimagined stores and that concept, how well it's doing, and does that become a template for the other 1,000+ stores going forward?
Yeah. So our new store is up and running in Columbus, Ohio. We have 10 planned for this year, plus some remodels will take us up to about 20 different versions of it. Out of the gate, the customer response to the store has been tremendous. We're very excited about what customers are saying about it and the sales growth in those stores. And what we will do is there's headroom for this business. We're going to continue to build new stores this year and, you know, for the foreseeable future. That will be our new store model. But what great retailers do and what we're doing is we take the learnings of that, what really resonated with consumers, and then roll that out across the chain.
When you say more stores, does that mean your total footprint is
going up?
Total
footprint is going to grow.
Okay.
And we've been investing in our stores, and you're going to continue to see our capital go towards our store network.
Well, that's sort of where I was going to go next, because you think about, you know, the fact that you've been at the helm for 16 months. It's been an eventful 16 months. What do the next 16 months or so, whatever time frame you want to pick, what do they look like? What's the priority?
Yeah, so the priorities are the following, and it's pretty straightforward. Improve the retail experience, primarily through stores, but also improve our digital business as well and our interaction with consumers. Transform our merchandise, our core merchandise, to continue to increase relevance. And then services and events are a big part of our proposition. So this is kids' birthday parties. This is free kids crafting all summer. This is teaching people how to sew. And so we're continuing to build out that business, all on top of a business that's powered by this analog trend and our entry into these new categories.
All right. Well, I can definitely tell you, David, I have a couple of nieces under the age of 11. They're both big knitters.
Great.
And crocheters and things like that. So you're definitely tapping into something. David Boone there, the CEO over at Michaels. When we come back, we're going to take a look in at those oil prices, that big spike up, and the latest commentary from President Trump on the situation in Iran. That's coming up next, right here on The Close, right here on Bloomberg.
Well, our stock of the hour becomes a sector of the hour as we watch oil prices, which are sharply higher as President Donald Trump reinstates his blockade of Iranian ports, saying that enforcement will begin at 4 p.m. Eastern tomorrow, also planning a 20% charge on all other cargo shipped through the waterway. As you might expect, you have oil prices higher by about 9% when you take a look at Brent, when you take a look at New York crude, and as such, energy is your top performing sector in the S&P 500 today. today.
Yeah, we kind of came in today with oil already elevated because of what transpired over the weekend. But then you got all of these headlines from Trump around kind of 10:20-ish, 10:30-ish Eastern time. I don't know what to make of it. Obviously a new blockade of the Strait of Hormuz, but also just a reminder, quite frankly, that this thing has never been resolved. And you have Brent crude back solidly above $80 a barrel, WTI around that 77, 78 a barrel number.
Yeah, and you see that risk premium being reinserted back into oil in a big way. I mean, we haven't seen a move like this in quite a bit.
And I think you mentioned a little bit earlier in one of our conversations about Christopher Waller and some of his comments and the idea now that the inflation story and more importantly, the potential increase in Fed rate story, that actually might be back on the table primarily because this hasn't been resolved.
Absolutely, and all eyes on CPI tomorrow will certainly be top of mind. But coming up, it's the closing bells. We're going to take you there next with Alli McCartney. This is The Close.
Welcome back to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld. Of course, we are 10 minutes away from those closing bells. The S&P 500 not quite at session lows as we count down, but pretty dang close, down about 0.8%. A lot of that weakness coming through in big tech. And certainly, as we've been talking about oil, that risk premium being priced back in. Brent prices higher by about 9% and a sell-off in the bond market to boot.
Absolutely. So you have that increase in oil prices, that increase in yields. That puts a damper, of course, on stocks. And it comes ahead of what is about to be an incredibly volatile few days as we start to get the earnings season, a slew of economic data. And we get to hear from Kevin Warsh, which, of course, comes on the backdrop of some interesting comments earlier today by Fed Governor Christopher Waller. Alli McCartney joins us right now, Managing Director of Wealth Management and Private Wealth Advisor over at UBS Alignment Partners. Great to see you again, Alli. I do want to start off first with earnings season because anytime we sort of had any sort of trouble in markets, there was always this idea that earnings growth was there, earnings growth would continue to be there, and it would be very strong. We start tomorrow with, of course, this fire hydrant out of the big banks. But as we get deeper into the season with the tech stocks and some of the others, are you still optimistic that those companies are going to deliver on some of these earnings expectations?
Very. And I think that's why, with all the back and forth that we've seen, you still see some support in this market. That support has largely been in short covering over the last month. But we're about to start second quarter earnings season. The expectation is for a 20% increase in earnings year on year. That's going to be driven, as it has been for quarters now, largely by tech titans, which are going to come in just shy of 50%. But you still have 11 of the 12 sectors likely to be up. And this is it's a high bar because we've been revising up and up and up. But it remains very, very consistent with the messaging that we've been putting out there, and many other banks have too, which is that there is a support level, and that support level is in earnings. And so there can be volatility, there can be some back and forth, but that ultimately multiples can expand into this earnings regime.
That gets to this idea of earning surprise, and it's going to be hard for some of these tech companies to surprise given how high the expectations. But there's been a few other strategists and analysts on this program that have talked about this idea of the non-tech sectors having the ability to surprise more meaningfully to the upside. Is the economic backdrop, was it there last quarter, more importantly, is it going to be there going forward for them to provide not only a surprise on earnings, but on guidance potentially as well?
I think it will. I think it's going to be very interesting when you, again, in those other sectors, because ultimately right now what you're seeing, and what we saw a little bit of last season too, is the market is hyper-focused on true revenue, productivity, and earnings increases because of positive effects of AI, not just spending on it. And so there's absolutely room, I think, in those other sectors and in individual stocks, should they be able to demonstrate growth and increased productivity. Now, it's going to be a little bit of a tale of two cities, because there are certainly going to be a number of stocks and companies that are going to have trouble both meeting and extending their earnings based on some of the pull away they saw from gas and energy prices last quarter. But just as we expect this week to see in the inflation print, I think you will start to see forward guidance, even with what we're seeing now with renewed tensions in the Strait of Hormuz, reflecting a positive trend, a decrease in both short and long-term inflation.
Well, you mentioned gas prices, and certainly they were a starring character when it comes to Pepsi's earnings. I want to talk a little bit about the earnings season for some of the Magnificent Seven. We have a couple of weeks to go still here, but you think about the fact that this group in the market has lagged year to date in a pretty meaningful way. As we head into some of these reports, how do you think that will change the narrative and thus how they're performing relative to the rest of the market?
Well, look, I think a lot of this depends on the semantics and arbitrariness of what your time frame is, right? So if you look at a series of rolling 12-month periods, if you look at, let's say, 3 years or 5 years, these stocks outperform. And why do they outperform? Because they are ultimately creating earnings. And so I think for them, the comps from last year and the bar is getting higher and higher, right? So 50% earnings growth from those Mag 7 stocks plus the semis is nothing to sneeze at. But when you had 100% or 150% growth, and you're sort of relatively looking back, it's less exciting. But I believe in the transformational power of AI. I believe in it not only for the hyperscalers, but for the sort of entire corporate, S&P 500, Dow Jones kind of world. And I think that it's going to be slower to show, but that we really, even last quarter, as I said, started to see it. And so you are still seeing, a very high concentration of both earnings and market capitalization in most of our indices. But you are also seeing, it can be and not but, you are also seeing an earnings broadening. So I think both can be true going forward.
Well, in addition to earnings season unofficially kicking off with the big banks, we have a very important CPI reading tomorrow. We're going to hear also from Fed Chairman Kevin Warsh. And when you think about the backdrop right now, you had Fed Governor Christopher Waller calling out core CPI as the figure to watch tomorrow. We know that bond traders see about a 50% chance that the Fed will actually hike rates this month. And when you think about the possibility of rates being raised here, Alli, do you think that that's something that the market is potentially prepared for?
So first of all, I will say that we at UBS don't see that as the next move. We see no movements this year and then easing next year, right? And to me, the commentary that was released today maybe was a little less hawkish than what we heard at the last Fed meeting. And clearly, I think in the testimony we're about to get, it has already been brought to our attention in myriad formats that Warsh is not going to communicate and prognosticate and let us see what's going on sort of under the kimono, the same way that past Fed chairs have. And I assume that this will be a pause. And I think that what we're likely to see is, Warsh made very clear that the primary focus of the Fed is price stability. We're about to get, I think, some leeway on that again, given the energy prices of the last, let's say, month and a half. Yeah. But that's what we need to focus on. And to the extent that we do have peak inflation behind us, then what you are going to see is some volatility in the interest rate market, but ultimately you're going to see a pause that ends in a easing next year.
Alli McCartney, Managing Director of Wealth Management over at UBS Alignment Partners, counting us down to the closing bell. Our simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic joins us right now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube as we parse the most crucial moments of the day. Tim, you missed a lot last week, but don't worry. We've erased all of that here today with stocks down deep into the red.
Well, what did you say when you came back?
I was like, we're talking about the Strait of Hormuz and oil again.
Okay. Yeah, time is a flat circle.
I don't think you're wrong about that, Katie.
Yeah.
Look, this was supposed to be, and higher oil prices were supposed to be in the rearview mirror, and I'm kind of jumping on what you're going to be talking about, Carol. But we have Brent up more than 9% today. We have WTI up 8.8%. today. I thought higher oil prices. I thought we were past that.
Yeah, we're not past that, and I think any given day, investors look through it, and sometimes they do. I'm starting to think about, though, what we will be focusing on, especially as we get that big drop of earnings tomorrow. 5 big banks reporting their results. So that commentary, Katie, will be so important about kind of the health of the economy, the health of lending, the health of the consumer.
Yeah, really an embarrassment of riches when it comes to potential catalysts this week. You mentioned big banks kicking us off early tomorrow morning. Then we have CPI. We're also going to hear from Kevin Warsh himself and Fed Governor Christopher Waller. I mean, I feel like he really threw inflation and the possibility that this Fed is going to hike rates firmly back into the conversation when he said focus on core CPI.
Absolutely, and quite frankly, I mean, you don't even need to focus on the core. You can put all the oil and gas back in there, given the big bump up that we saw today and what looks like a still heavily unresolved issue when it comes to Iran and the Strait of Hormuz. Right across the screen here on this Monday afternoon, modest losses for the Dow Jones Industrial Average, losing roughly about 138 points or 0.25%. The S&P down about 60 points or 0.8%. The Nasdaq Composite and the Nasdaq 100 taking it the hardest. The Nasdaq Composite down about 1.6%. The Nasdaq 100 down about 1.9%, while the Russell 2000 losing roughly 25 points or 0.8%.
All right, back to the S&P 500 I go. A little bit of an even split. 273 names actually gaining ground on this Monday. 230 to the downside, and then we've got Tim, 0 unchanged.
Yeah, did you see what happened to the stocks today?
Yes.
Yeah.
Got killed.
But you know what? Still up, Katie, more than 65% this year.
Yeah.
But all 30 members of the stocks down. Then the whole stocks fell 4.8%.
It was an ugly day for those chips, but as you mentioned, I mean, coming off some pretty incredible gains. Let's take a look at the sector performance today as measured by the Circle, because, boy, what a fantastic day for energy. You can see that small slice in bright green. That is energy. That sector higher by about 3.2%. But the reason why we saw such a big decline is information technology on the other side of that sector down about 2%. So clearly that is the big weight that dragged indexes down. But also a good day when it came to utilities, financials, consumer staples. And then on the downside, in addition to technology, you also had communication services and industrials fall today, Carol.
All right, guys, let's go to some of the individual gainers. And I got to talk about Paramount Skydance and Warner Brothers Discovery, because you did see Paramount Skydance up as much as 4% in today's session, finishing the day, with a gain of about 1.5%. Warner Brothers Discovery was up as much as just about 4%, but it too finished the day with a gain of about 1.9%, so off its highs. But nonetheless, you know the story. We've all been talking about a group of 12 states suing Paramount Skydance, seeking to block its bid to buy Warner Brothers Discovery. They allege the deal would leave viewers with higher prices and fewer choices for movies and TV. So, yeah, this is going back and forth. We did get a statement, too, from Paramount. Pretty broad in general from what our Jennifer Rhee, who covers antitrust at our Bloomberg Intelligence team. But nonetheless, back and forth again, and so there's going to be some litigation, or we'll see whether or not these guys settle. But nonetheless, we did see investors coming back into these names. And I feel like I have a theme of like deals that are happening or some snafus. I want to go to Mattel and Hasbro. Mattel shot up to more than 7% intraday, finishing with a gain of 3.8%. Hasbro was up almost 3% at its intraday high, finishing with a 0.7% gain. And what we saw that UBS came out in a note today, said the investment case in Mattel is not just about toys, but its portfolio of brand equity that is worth far more than the market currently attributes to the company. It says it owns one of the most concentrated portfolios of evergreen multi-generational family entertainment intellectual property. They maintain their buy rating and a $28 price target, but also late on Friday, Ariel Investments' John Rogers said as a panelist for Barron's mid-year roundtable that he recommended buying Mattel in last year's mid-year roundtable and recommending it again, saying activist investors are now involved, with Southeastern Asset Management having sent the company an open letter in May urging them to explore a possible sale to Hasbro. So he's basically saying, given the current regulatory environment, this would be the time to put these two great companies together. And one more, not a household name, ticker is FERG, Ferguson Enterprise, up 2.5%. The company rose after the products and solutions provider for areas including plumbing, HVAC, and appliances agreed to acquire FWI Holdings from Winchurch Capital. And so the thinking from some of the community that weighed in, the analysts, is that it may be basically kind of expands their market share. So a lot of deal flow we're finding.
A lot of focus, too, on chips, as I mentioned.
Yes.
The stock's falling more than 4% today. I do want to talk about SK Hynix ADRs, down 9.3% today. Shares of SK Hynix plunged a record 15% in South Korea. We saw the Kospi index down 9%. It triggered a market-wide trading suspension. So wanted to highlight this new ADR here in the U.S., down 9.3%. Kenvue shares also under pressure today, down 1.3%. A federal appeals court reviving lawsuits claiming that Kenvue hid alleged risks that Tylenol could cause autism in children whose mothers took the medication while pregnant. The decision allows the case to proceed. The plaintiff's attorney says that it's a vindication for scientific evidence presented. Kenvue emphasized that the ruling didn't address the underlying facts of the case. Kenvue down 1.3%. And this was among the worst performers in the S&P 500. I'm talking about the ad tech company AppLovin. Shares fell 12.7% today, Romaine. Bank of America cited data that said that the company's e-commerce footprint is expanding at a slower than expected pace following making this new platform available to everyone that it released a few months ago, sort of a soft launch, but now it's available to everyone. And according to Bank of America, the rollout's going a little slower. Shares down 12.7% today.
All right, a quick look at yields higher across the curve, particularly on the shorter end with that 6 basis point jump on the 2-year yield, pushing it back to the highest levels going back to 2025. They were already elevated coming into this session, but some of the hawkish commentary we heard a little bit earlier from Fed Governor Christopher Waller certainly not helping when it comes to the sell-off that we saw and when it comes to Treasury prices.
All right, guys, some stories on our radar. And I don't know if you saw it, but it sounds like it's going to get hotter as the week moves on. A story that caught our attention by our Samantha Kelly about this Dyson portable fan. I haven't seen it. The HushJet Mini cool portable fan. It's about $100, but it's being hard to kind of get a hold of since I guess it has become in high demand because of all the high temperatures that are out
I've
there.
actually never seen this thing either.
I've
I
never
first heard about it in this article, but apparently everybody wants to buy these. The company says consumer reception has been incredible, as you said, Carol. The HushJet Mini Cool has a strong airflow, several speed settings. It's got trade-offs, including being heavier than expected. Not as quiet as people.
Yeah, these things aren't quiet, but I see them everywhere, particularly. Yeah, and they're not quiet. I mean, you definitely hear them.
But isn't it?
It's like a data center hum.
Oh gosh, I haven't seen them either.
It's called
either,
HushJet,
but
though.
well, that can be
It's
misleading.
wishful thinking.
I feel like I've seen a lot of knockoffs potentially of this. I mean, it's just a fan, and I feel like you walk around,
Katie,
especially on strollers, and you see a lot of these handheld fans.
Oh yeah, you should get one. Well, now we know what to get Katie for a shower here.
If you can find one.
Yeah.
Yeah.
All right.
I don't need the HushJet. It's all right.
Another story I was keeping an eye on. I know you're a big sports fan, Tim Stenovic. I don't know where you were, but the Seattle Seahawks finally have agreed to a sale. There's been a lot of speculation as to who would actually get it, as the estate of Paul Allen was seeking to unload it, and they did for $9.6 billion, and it goes to, of course, Vinay Khosla, who is the former founder of Sun Microsystems, or probably more known for all the venture capital stuff that he's been doing since the 80s, including being an early investor in DoorDash and Instacart and a bunch of other big companies like that, which gave him the billions to buy this company.
Yeah, absolutely. I mean, you think about what we're talking about here. This deal valued at $9.6 billion. I can't admit, or I can't pretend that I know much about football, but I definitely know the Seattle Seahawks.
What do you know more about?
They're in Seattle.
American football or European football?
Oh, definitely American football. I have no idea what's
How
going
about,
on.
where have you been, Tim?
Where was I?
Yes.
we
I was
missed
watching
you.
the World Cup, obviously.
Oh, okay.
Yeah,
Wow.
big sports guy.
Were you in Seattle?
And in fact, they don't call it the Seahawks Stadium.
I know.
They just call it Seattle.
Seattle. It's like New York,
Los
New Jersey
Angeles.
Stadium. Los Angeles Stadium.
Yeah,
you
it's
can't
very,
buy branding like
it's
that.
very confusing.
Yeah.
I thought Khosla was a California guy. He's got his allegiance in.
It's West
It's on
Coast.
the same coast.
You know, Tim, there's only so many teams that come up and say, oh, look at this guy, Debbie Downer. Where's your $9.6 billion to buy this thing?
Yeah.
You're a West Coast, you're a California guy.
Yeah, I am.
And you didn't bid?
Well, you and I were going to go in on it, but
Yeah, they rejected our measly bid of $1,600.
You might be able to buy one of those fans if you could find it, but I don't know about the team.
I'll get one too for you too, Carol.
All right, no, you won't. All right, that is a wrap. Our cross-platform. It's a Monday. Radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Katie and Romaine continuing there on television, on the close, and Tim and I back here on Bloomberg Business Week Daily on Bloomberg Radio. Folks, we will see you again, same time, same place tomorrow.
And another big sell-off in the chip sector today. We're going to take a deeper dive into exactly what has been vexing investors. Gil Luria, head of technology research at D.A. Davidson. He joins us after the break, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A down day to start the new week. A ton of catalysts on tap, and investors really trying to find a way to adjust. The S&P did close down about 0.8% on the day, led largely by a big drop that we saw once again in the chip sector. The Philadelphia Semiconductor Index down about 5%, though we should point out that's the biggest one-day drop since like 2 weeks ago here, really a symbol of the type of volatility that we continue to see in that space. And keep an eye on bank, which we get about 5 of the big U.S. banks reporting earnings, all within basically about an hour-long period tomorrow morning. But breaking news right now, this regarding the big move higher that we've seen in oil. Brent crude up about 10% on the day, and when the new session opens, it may even go higher. A redhead crossing the Bloomberg terminal right now. President Trump saying that the U.S. plans to hit Iran, quote, hard tonight and tomorrow. Katie Greifeld.
And of course, that jump in oil was a big upside catalyst for the entire energy sector today, so we'll keep an eye on that. But let's talk about some of the other movers when it comes to the individual stock level, because I wanted to highlight Chipotle Mexican Grill, as we discussed with the CEO, the restaurant chain expanding into Mexico. That's happening this week. Shares higher by about 4%. Also keeping a close eye on what's going on with SpaceX. Another day of declines, shares falling about 4.2%. Closing just about at $139, getting closer and closer to that IPO price of $135. And then, of course, SK Hynix ADR is top of mind as well, falling about 9%. And that's our top story this hour. In AI-fueled stock rout in South Korea, spilling over into U.S. markets. ADRs of SK Hynix falling in its second day of trading, with memory and storage peers dropping across the board. Micron, SanDisk, and Western Digital all in the red, even though, Romaine, you had a 36% jump in TSMC's quarterly sales that really failed to lift sentiment in the space.
Yeah, and I'm glad you brought that up, because it is showing a bit of a disconnect right now between what we're seeing with regards to those fundamentals and with regards to investor sentiment around this space. Gil Luria joins us right now, head of technology research over at D.A. Davidson. And Gil, that is where I want to start. It's kind of funny, when we had this big rally in these chip names over the last few months, it was kind of the opposite effect. You seen you had this euphoric sentiment, and everybody was wondering, are the fundamentals going to match it? Now we're getting proof of life that the fundamentals are there, but everybody, for some reason, still seems to be looking for the door. Is this just profit taking, or is there something more significant going on with regards to investor sentiment?
The profit taking is a part of it, but investors just overall are concerned. There's a notion, in a sense, that because we're spending so much, because earnings for these companies have gone up so much, that can't possibly continue. And we would argue that we are seeing signs that there is a lot of activity, a lot of real economic activity happening around AI. If you add up the revenue run rate for OpenAI and Anthropic, and maybe pieces of Google and Meta that are relevant, XAI that are relevant, you get to about $100 billion revenue run rate. That number was 0 2 years ago. So clearly there is real economic activity happening, which is to say, the companies that are buying chips will likely continue to buy them. And specifically in memory, we're not making nearly enough chips. And we won't be making nearly enough chips, at least for the next year or two. So the fundamentals are still very good. Indications are that they stay that way. But investors that have gone through this long ride are now worried that maybe the ride is coming to an end.
Well, I am curious. We got the update from TSMC. We get the full earnings report in a couple of days. ASML over there in Europe also scheduled to sort of put its cards on the table, I believe, on Wednesday, U.S. time. Is there a sense here that we can divine something from those earnings reports that feeds into what we would expect out of NVIDIA and Qualcomm and Broadcom, et cetera?
Yeah, absolutely. And those results are very good and continue to be very good. In fact, again, all the semis that have reported anytime recently have reported accelerating revenue growth, because the purchasers of compute, the Amazon, Microsoft, Google, Meta, et cetera, are buying more and more. And they're likely to continue to say that. So in a couple of weeks, Google will report, that Microsoft will report. What they're going to probably say is, look, our CapEx is probably going to go up next year. It won't go up as much as it did this year, but it's still going to go up, which is to say the demand for semis will continue at least into next year. Now, what happens after that? Obviously, there's a big debate in the market. Are we close to a peak? Is the peak in 2030? We see the opportunities in the stocks that are priced as if the cycle is peaking. And we think the stocks that are overvalued are the ones where there's an assumption that the cycle peaks in 2030. So NVIDIA, Micron, SK Hynix are priced as if we're rolling over in the cycle. That makes them the opportunity. Intel, Cerebras, a lot of the semi-cap, optical, nuclear names are trading as if the party's going to go on at least till 2030. That's where there's more risk.
Well, Gil, you're touching on something that I've been wondering about. Once we roll into some of these reports from the big heavyweights in the tech space, and you hear in your expectation that they're still committed to their CapEx plans, do you think that will be enough to reset sentiment? Because again, as Romain pointed out, as you've pointed out, the fundamentals are there right now, but it's just the stock that's not responding.
Yeah, I think they need to thread the needle. So what I would expect, let's use Microsoft as an example, because it's their fiscal year end. So they're going to guide 12 months ahead on CapEx and revenue growth. If they say Azure is going to grow more than 40%, it's going to accelerate, and CapEx is going to decelerate, grow less than last year and less than 40%, that's a very positive message. That means AI is working, Microsoft's getting a return, and they don't need to continue to accelerate CapEx in order to achieve that. If they can deliver that message effectively, it should help the entire AI sector.
Well, Gil, you also made the point that you think about how some of these names are trading. They're acting as if, things are already rolling over. And I feel like one of the narratives that's haunting some of these memory stock names right now is that memory typically has been a very cyclical industry. And you've heard that from maybe some more bearish commentators on the street. And I wonder whether you think that the sector overall has been able to escape some of those patterns that it has historically had.
Well, all semis are cyclical. But I would argue that now, as we sit here today, memory may be the least cyclical, at least for a company like Micron that went up into its earnings call and said, look, we signed 5-year deals. We exchanged a little bit of the upside to eliminate the downside. So all semis are cyclical. GPUs are cyclical, TPUs are cyclical, CPUs are cyclical, but memory is now being sold in 5-year deals. So it is actually less cyclical than all those sectors. And yet the long-term memory is persistent here, which is why these stocks are trading at such a discount. CPU stocks trading at 40 times earnings and more, memory stocks trading at 8 times earnings or less, in spite of the fact that I would argue CPUs are now more cyclical than memory.
Well, it gets to this idea then. I mean, if we are seeing a real transformation here in that relationship, Gil, do you have confidence, though, that that is indeed, are we going to be talking about this 10 years from now in the same manner, meaning the idea that it's a bit more of an acyclical or less cyclical industry, or are we kind of deluding ourselves into just what is basically still a cycle, just a much more prolonged one?
Yeah, I'm not arguing that it's not a cycle. This is just the nature of things, that when you build a lot of supply, sometimes you build it ahead of demand. There will be a cycle at some point. It's just the level that the cycle is happening at is much higher. And again, for a company like Micron that's using its current market power to lock in 5-year contracts and eliminate the downside from the cycle, that's a much better view. So the cycle is at a much higher level, and they've eliminated the downside. That's why we find them so compelling right now.
All right, Gil, always great to get some time with you. That is Gil Luria. He is head of technology research over at D.A. Davidson. Now, coming up, timing that IPO window, what SK Hynix's U.S. listing tells us about the potential IPOs to come. That conversation up next. This is The Close on Bloomberg. Well, the U.S. listing of SK Hynix fueling an already hot IPO market with mega deals boosting U.S. volumes past 2021 highs. Now, at the same time, companies withdrew or postponed $2.1 billion worth of transactions since the start of the year, raising questions about the timing for major listings still in the pipeline, such as OpenAI and Anthropic. Bloomberg's Bailey Lipschultz joins us now. And Bailey, I love that stat that you think about the $2.1 billion worth of postponed or withdrawn transactions altogether. It feels unintuitive because overall, I mean, the IPO market has been red hot this year.
It has, Katie, but when you look at the deals that are being postponed or withdrawn, they're in Europe or they're exposed to industries that are underperforming. When you look at what's been working here in the US, it's been anything around the build out of AI, selling AI chips, or at least the dream of AI, a la SpaceX. So the big question from a global perspective is, what do investors want? Well, they want themes that are working, and they pretty much want to avoid anything that's not. It's been interesting to track KNDS over in Europe. When they postponed their IPO, if you go back a few months, it seemed like defense, any deal could get done, but that's no longer the case. That's just how quickly these markets can shift.
Well, I am curious also, too, just about the idea, Bailey, of some of these companies, some of the non-U.S. companies looking towards the U.S. I mean, obviously, we talked about the ADRs of SK Hynix, but also vending spoons coming here to the U.S. Is the idea that if you have that narrative and that story, you're going to end up not just coming into that IPO market, but you're going to make sure that it's here in the United States?
And Romaine, you're going to benefit from at least the banker pitches, deeper markets, markets that are more than happy to give you a premium valuation than your likely local listing. And to that point, it becomes a question of, can you sell a story that U.S. investors buy, especially retail investors buy, and hold on to? The big question coming into this Hynix IPO was, could they maintain not only a premium, but could they expand that? The premium's sitting pretty darn good relative to those Korean shares. It's just the underlying inherent volatility when you look at an SK Hynix, which is a $1 trillion company that trades in Asia, where we've seen stomach-churning volatility for a number of weeks at this point.
Well, when it comes to SK Hynix, this is something we were talking about last week, of course. You know, what the idea of whether or not this would attract more of these foreign companies to come to the U.S. and list, or is SK Hynix, you know, such a different situation, you know, such a a shiny object at this point, given that they are at the center of the market mania, that maybe you can't extrapolate out from it?
It depends, Katie, to your point, what box you fit into. Kioxia, which is a Japanese semiconductor company, has been vocal about plans to list ADRs here in the U.S. in the first half of next year. That's spot on to the theme of the AI build out in semiconductors. If you're a similar company and your business looks a lot like that, a la Samsung Electronics, who bankers, as far as I know, have been trying to steer towards the U.S., but management hasn't wanted to, that's perfect. And that's a story that in this point in time, the U.S. market would willingly pay up for. Bending spoons, interestingly enough, kind of fits into a slightly different bucket, you know, kind of that VC roll-up model, AOL, and a number of other apps that people wouldn't have expected to be executable, but they are doing that because the utilization, or at least the pitch of AI, and streamlining that margin story.
All right, Bailey, always appreciate it. Bailey Lipschultz there. A closer look here at the IPO pipeline, just how packed it is and whether it all finally comes out. Now, when we come back, a conversation with the CEO of New Mountain Capital, Steve Klinsky, who says it's a great time for buying across private markets. That conversation coming up next, right here on Bloomberg. All right, we talk a lot about private markets on this show, and depending on the day, you can, well, say things are doing good, or you can say things are doing bad. A lot of mixed signals being flashed, and Bloomberg Intelligence noting that fundraising momentum, well, that is on the upside. It overcame redemption concerns in the first half of the year. However, lending activity does remain subdued. Data from Reuters and PitchBook showing U.S. direct lending volume actually falling 50% quarter over quarter. Joining us right now to talk a little bit more about the state of private markets is Steve Klinsky, founder and CEO of alternative investment firm New Mountain Capital. Great to see you here, Steve.
Nice to see you. Thanks for having me on the show.
So let's first start off with the redemption request and the idea that, at least based on the data we've seen, this didn't seem to scare away too many folks. It seems like fundraising has gone pretty well, certainly if you're one of the larger PE or private credit firms out there. Are you seeing similar appetite out there right now for investors to come into this space?
Well, the redemption requests were in credit, and they were on the retail side. I think what you're seeing are the smarter institutional investors are now going more into credit to take advantage of the low prices. And as you mentioned, in private equity fundraising, it was up from last year. And I think you have a big backlog of companies waiting to be sold. So you're likely to see a pickup in both loan activity and exit activity in the coming months.
When you look at the redemption requests, you said that was primarily a function of what we saw on the individual investor side, the idea that maybe some of the nature of these funds wasn't necessarily pitched in the right way, or at least the investors didn't understand them. You did not see, or at least in your view, you did not see any real concern amongst the larger institutions themselves.
Well, I think things have traded down, and I think it's oversold. So I think there was a justification for some decline in valuations, but I think the market's overshot, and I think some institutions have also decided that the market overshot to the negative side.
And it's interesting when you think about the most recent quarterly redemption requests that we saw broadly across the industry. I mean, they picked up from the prior quarter, and I wonder if you have any concerns about industry-wide where that leaves the quality of those portfolios on the heels of those redemption requests. Because, you know, if you're selling assets to get cash to give back to investors, I have to imagine it's the more liquid, potentially better quality stuff that's going first.
Yeah, I mean, in my own experience, what we're seeing, first of all, we didn't have any excessive redemption requests in our own funds, but I can't really speak to what's inside other people's funds. But I think the SaaS apocalypse is, you know, well overstated, and I think it's just a pendulum. I think also if you're doing redemptions, let's say you want a piece of your fund out, you may make a bigger redemption thinking you're going to be scaled back, so the redemptions may be overstating because people don't expect to necessarily get 100% of the redemption.
It's a fair point, you know, trying to sort of game that so you do get what you want here. But let's compare and contrast, because you mentioned, you know, you think about private credit, seems oversold right now. Some of that SaaS apocalypse, doom mongering, whatever you want to call it, maybe a little bit overblown. But when it comes to PE, it's a different picture here, and you see the deal flow picking up. I mean, what about this environment sort of lends itself to that? And when do you think that materializes into more meaningful exits?
Yeah, well, for my own firm, we've had 5 exits already this year. We have $4.5 billion going back. So, and we've had 5 or 6 steady years of way more money going back than we draw down. So I think, remember, there's 5,000 firms, so it's hard to make any general statement about all private equity. But I think we're in a situation where companies are, you know, we've had the Iran war, we have other things that have delayed people's timing, but there's some good purchases out being made. We've also bought a bunch of companies this year. And I think, you know, I think it's actually a good time to be buying companies. Whenever you have bad news, it's usually a good time to be going in with fresh money on buys, or if credit goes too far low, it's a good time to come in and buy credit.
Well, to the point that you made that you think things maybe look a little bit oversold when it comes to the private credit side of things, are you seeing any discounts when it comes to PE, especially when you think about the software space?
Yeah, well, what we're saying is, you know, on our exits, if you have a company in a clearly great space, like we sold a company that is engineering the growth of the power grid or the water grid, those type of businesses are holding very good value. I think for the average business that, you know, multiples might be a point or two lower than they used to be at the height. And I think where there might have been overpayment was back in 21, some software companies were bought. So you might have a bad vintage for software companies in 2021, but that is like a bad crop in agriculture. Doesn't mean that farming doesn't make sense as a practice. So I think it was really overpayments in 21 on some software companies.
I am curious with some of the exits here. I mean, some of that goes into continuation vehicles. Are some of those also going to the sponsors as well?
Yeah, we've been selling to sponsors, we've been selling to strategics, and we are a big believer in trophy asset continuation vehicles as an important evolution in private equity, and we've done some of those ourselves.
And just the structure of these, though, particularly on the continuation side, I mean, people are comfortable with it because, I mean, there are some people that will look at, okay, well, if we have these continuation vehicles, you have the GP basically sitting on effectively both sides of the assets, getting additional carry on something that traditionally would have actually been carried out, so to speak.
Well, the way I view it is I've been doing private equity since 1981. I think it's one of the most important evolutions in the space, that if out of every 10 or 15 companies, you have a truly great company, you've worked on it for 5 years, you've doubled or tripled the value, you think you can double or triple again. One of the criticisms of private equity is, why do they always sell out of these companies so soon? It's because that was the only way you could behave. Now it's been established that if you have a great company, you can keep it going longer.
Yeah.
And the investors can get out who want to get out, and others can come in who want to come in. So it's just an extra choice for the LPs. They don't have to get out.
Well, I'm interested too, as people stay longer in some of these companies. A little bit earlier, I know you're not involved in this, we were speaking with the CEO of Michaels and the idea of this private equity backed by Apollo, and it's had a pretty good turnaround. And obviously there's a lot of speculation, okay, they've held it for 5 years, why didn't it get out? But there's also this idea of, do you just want to manage it longer? And I am curious if there is an incentive, particularly if things are going well, that would you have an incentive to maybe managing these things longer, even if there is maybe a clear exit point?
Well, I think we and the LPs both have an incentive to stay longer. It's like if you're a fisherman and you fish 10 fishing holes and you found a great one and things are going wonderfully and you can see a great future, you don't want to have to just leave because time has run out. So it's not for your worst companies. It should be for the company that you have the clearest future, but just to sell it to another private equity fund so they get all the gain leaves your LPs high and dry. On the other hand, you don't want to force them to stay for 10 years. So I think it's a pretty Solomotic choice. If you want to exit, exit. If you want to stay, stay. And the GP is showing their own confidence by staying.
And so when it comes to continuation vehicles, I mean, Steve, you make a great point that, you know, if you've worked on this company for 5 years, you don't want to just do away with it because the time ran out. But even still, I mean, continuation vehicles, they do have this reputation of, you know, it's when PE sort of is shuffling around bad assets and et cetera. The SEC, Bloomberg reported, is actually probing some of the continuation vehicles out there. We reported this in late June. And I wonder, you know, in your view, whether you think that is happening on an industry-wide scale, not necessarily at your own shop, but is any of that reputation deserved?
I mean, I think that's a very unfair way to think about it or present it. I think, again, the way I've talked about on single assets, again, 1 out of every 10 or 15 companies where you've spent 5 years working it, you've put the right management in, you've got the strategy right, you have a clear path for the future. You know, PE used to be criticized for being short term, and why don't they hold things longer than 5 years ever? And now that we are, people say, why do they hold it longer for 5 years? So I think if you do it for the right reasons, it's a very good thing for everybody.
And it's good perspective how the pendulum swings there in terms of how you can be criticized. But let's talk a little bit about where you are staying away from. When you think about the sector level, the industry level, I mean, what doesn't make sense right now?
Yeah, New Mountain itself has always had 2 ideas, defensive growth and business building. And one of the great luxuries of private equity, you don't have to inherit your grandfather's iron foundry and turn it around. You can always say at this point in time, what's the right space for the next 5 or 10 years? So we now have 12 sectors staked out with 25 subsectors. We've been doing a lot in infrastructure services, building out the power grid, the water grid, geospatial, those type of things. We're doing a lot in accounting firms we think are great diversified businesses and that AI is actually going to help them, not hurt them. We do a lot in must-have data. So but we've always stayed away from, you know, cyclical housing, from fashion, from restaurant concepts, from oil price linked companies. So we've always had defensive growth, but we slowly evolved the list over time.
I'm curious. So I'm told that every year at the start of the year, you and your team kind of sit down and really kind of go over sector selection and kind of like based on the conversation you had at the start of this year, whenever that meeting was, how things have played out so far through the first 6-7 months of the year. Yeah. Has it been relatively in line with what you guys were debating back then?
Yeah, I mean, you can see we bought 3 infra services companies this year.
Yeah.
And we've been selling great infrastructure service companies from our last fund to harvest within the 5-year period, and then going back in so we can stay in the space and build it again. Or there's actually 9 niches within infrastructure, so we've been doing those. But like I also say, we own Grant Thornton accounting firm, we own big data companies. So those themes are playing out, we believe, very well for us.
You mentioned, you kind of alluded to how long you've been doing this. Obviously, you started Goldman's PE business back in 1981, before branching out on your own with New Mountain. What's changed in the PE world in a significant way from the 80s to where we are today in 2026?
I think a lot has changed, and I think it's changed for the better. And I've also been chair of the industry, the American Investment Council, and I say private equity's gone from a form of finance into a form of business. Back in 81, we were in stagflation. The 10-year treasury was 15.84%. The stock was about 6 times PE. And it really was about 4 investment bankers in a room borrowing as much money as we humanly could. And with 95 parts debt and 5 parts equity and 10% inflation, you could triple your money in a year with no growth. So that's where private equity started. Now it is a form of business. I have 300 people at my firm. We employ 133,000 people at the companies that we own. We'd be 52 in the Fortune 500. And it's having a team of people, not me, building business after business. It's every aspect of business building, and that's what good private equity should be. And if you have a great company, you spend 5 years building it, you may want to keep building it because you have great plans for it.
It's funny, you mentioned the 15-16% interest rates, and so when people ask you now about the Fed funds rate going from 4.5 to 5, do you just chuckle?
That's what I do, actually. I mean, the highest interest rate, I started October 181. The highest interest rates in history were the day before I started work. So when it goes back up to 4%, I go, oh, this is not, the world is over. And 25 basis points, I say, does your whole industry change because of 25 basis points? Like, not really. So, and actually, when rates are high, your purchase prices are lower, you get better buys. So we're always buying and selling, so it's a pretty normal environment if you look at historical averages.
Well, Steve, really enjoyed this conversation. Great to get your perspective. That is Steve Klinsky. He is the founder and the CEO of New Mountain Capital. Meanwhile, a quick look on where we closed out on the day on this Monday. Not too pretty. The S&P 500 down about 0.8%. You can see a lot of that pain was coming through when it comes to the chip makers, down by 4.8%. on your Philadelphia Semiconductor Index. The KBW Bank Index, something to watch as we start off a wave of bank earnings tomorrow, and Brent crude now higher by about 10%. This is The Close on Bloomberg. Investors bracing for a bank bonanza. The largest U.S. bank set to report this week, with JP Morgan, Citi, Wells Fargo, Bank of America, and Goldman Sachs results all due tomorrow. The largest lenders expected to show their second best stock trading revenue ever. Mike Mayo, he is head of U.S. large cap bank research over at Wells Fargo. He joins us now on set. First off, Mike, it's great to see you.
Thanks for having me.
So it's a little bit of an unusual situation to have 5 of the 6 biggest banks reporting all within, a span of a couple of hours of each other. And, before we get into the specific names, we'd just love to hear overall, what is your expectation for Wall Street this quarter? Because consensus on the street seems to say that trading looks particularly bright.
Well, I'd say overall earnings look very good. I'd look for earnings to be up 15 to 20% year over year. And if I had a tagline, it would be banks and barbells. And the barbells for strength, but it's not just overall strength in earnings and revenues and efficiency. It's a combination. On one part of the barbell is Wall Street, where we think the industry is poised to have record revenues this year for a variety of reasons, certainly fixed income trading, equity trading. Now you're seeing IPOs, an acceleration of mergers, but also Main Street. And I think that's the newer emerging story with this acceleration in middle America commercial loan growth. So some of that might be trickled down from AI, but also companies are saying, enough waiting. The geopolitical situation is the new normal. Let's build that new factory. Let's build that new plant. Let's have capital expenditures. And I think you're going to see that in the commercial loan growth at the largest banks and then the regional banks when they report too. So the two parts of the barbell, Wall Street and Main Street.
Right.
And I think that's a very good setup.
So banks and barbells, I mean, when you think about sort of the setup here, and then you go through your roster of coverage, which bank, if you had to pinpoint one of them, are you most interested to hear from at this juncture?
Well, JP Morgan is the biggest bank. They're first. We have Jamie Dimon, who is a generational CEO, and he just lost the person I thought was going to be his successor. So this is the first earnings call, I believe, when we have somebody new who will be overseeing the consumer business. So I want to hear his take on the economy, the financial system, the competition, and their positioning specifically as relates to the consumer now that they've shuffled management around a little bit. But he's always very authentic about what he thinks. He's very independent. And so will it be the sky is falling or things are okay? So that's always a big question when it comes to Jamie Dimon and JP Morgan's earnings. But I do think their earnings will be quite strong tomorrow.
I am curious, though, too, about the stock. And it's done relatively well. But is that also the Dimon premium? And what does that premium or lack thereof look like if he's not there?
Well, the stock has underperformed this year.
Yeah.
Over the last 3-4 years, it's been fantastic,
Yeah.
right? And under Jamie Dimon, since he became CEO, it's best in class. So, but this year things have slowed down because they're spending more than they're generating in revenues. And this is simply a timing mismatch. They invest for the 3 to 5 year horizon. And so you have confidence in them being the growth stock among banks. But there is a Jamie Dimon premium, and I think the bottom line with the exit of Marianne Lake is that investors want Jamie Dimon to stay. I think he'll probably stay another 3 years.
Yeah.
Investors did not want Marianne Lake to leave. She was the ex-head of consumer, but if that's the price to pay, that's the price you pay.
Talk to me a little bit about Citigroup. I was just reading a great story today in the Financial Times about a lot of the changes that Jane Fraser has made since taking over. In your view, have those changes been for the better? Do you look at Citigroup as a long-term growth story?
Come on, it's been my #1 pick for the last 2 years. Yeah. And as you know, I had the big sell rating on it back in the financial crisis. So, and I testified to Congress partly about Citigroup. So over 3 decades, I say Citigroup is undergoing a multi-decade cultural transformation. And cultural changes take time. It could take 5 to 10 years. But Jane Fraser has put this company on the right trajectory now. They've changed from 50 years of a global matrix structure to 5 lines of business. So it's easy to talk about it now. I abbreviate it by payments, banking, markets, cards, and wealth. That's it. And there's a CEO for each one of those 5 lines of businesses with targeted returns and CEOs that are responsible for achieving those returns. And there's nowhere to hide. Those 5 CEOs report directly to Jane Fraser. There's none of these co-presidents or dual heads or anything like that. And that is night and day different from Citigroup of the past. And frankly, it's better than, some of their peers too.
Yeah, absolutely. And we're seeing that, co-structure really emerge at a lot of the other places. I know that Goldman is particularly fond of it. I do want to talk about the other end of the barbell because we're talking about Wall Street, of course. But when you think about the regionals, and we have a little bit to wait here, how are you expecting, some of those smaller size, those mid-sized banks to perform?
Well, the stars of this quarter will be, Goliath is winning, the largest bank. That's been our theme. So that's going to be the big 5 that report. You're going to see some strong results. Citigroup, JP Morgan, Bank of America, and especially Goldman Sachs and Morgan Stanley. So they're going to be the standouts. But, surprise, not surprise, regional banks have some capital markets also. They benefit from record high stock markets. Their fee revenues can do quite well. But also that commercial loan growth coming back. And it's been a long way, decade to date, commercial loans, the traditional commercial loans. I'm not talking about hyperscalers or data centers or the AI stuff. I'm talking about plain old middle America commercial borrowing. I think this is an inflection point, and I think the regional banks will be talking a lot more about that. And I'll be digging into that, what regions, what industries, how sustainable. But I think this is quite sustainable for the next few years. So I'm ringing the bell on traditional commercial loan growth coming back, and that should help the regionals disproportionately more.
Only have about 30 seconds left. Is there anything that could surprise you this earnings season out of the banks?
I would say, and that's one of the questions, like Goldman and Morgan Stanley, what can make those stocks go even higher? Absent, if those 2 firms conducted due diligence for the big IPO and actually went to Mars and found gold, then maybe that would be extra upside. Okay. But no, if the sponsors came back with more activity, we've been waiting for that for a while, or if there's any credit issues, the talk of cockroaches, Jamie Dimon's term for credit losses, we haven't seen that for a couple quarters. If that were to come back, the market's not priced for that.
All right, Mike Mayo, of course, one of the best on the street, head of U.S. large cap bank research over at Wells Fargo. When we come back, we're going to set you up for what to watch over the next 24 hours right here on Bloomberg. Here's what the markets are going to have their eyes on over the next 24 hours. What to watch includes those earnings out of 5 of the 6 biggest banks in the U.S., including JP Morgan, Citigroup, Goldman Sachs, Bank of America, and Wells Fargo.
And then the good times roll on because 8:30 a.m. Eastern, we're going to get that U.S. CPI print. A lot of focus on that report. of course, always, but also after those comments from Fed Governor Chris Waller, taking a look at core CPI.
And it comes against an interesting backdrop because, of course, all of those earnings from the banks and that CPI data will come right out before new Fed Chair Kevin Warsh testifies before Congress for the first time, this time before the House Financial Services Committee, the old Humphrey Hawkins testimony.
Yeah, looking forward to comments from the chairman. We'll also hear from Barr, Goolsbee, Cook, and Bowman in terms of the Fed speak. And then 3 p.m., it's the close, but it's also...
The close, that's it. There's nothing else going on at 3 p.m. tomorrow, is there?
I heard there's also France versus Spain, but, you know, who's watching that?
All right, well, I tell you what, folks, bet on the close. We'll be back tomorrow right here on Bloomberg.